When you think about investing in stocks for the long term, I'm talking 5 years, 10 years, or even more, you want to think of companies that have the potential to double, triple, or even quadruple in that time frame. And of course, to do this, they need to meet a few requirements. So what I've done is I've kind of outlined a few questions that I ask myself when considering a company for the long term. The first is, can I see their market cap at least doubling over that time frame? The second is, do I see the product that they offer or the service that they offer become even more of an essential necessity out there in the world in the same time frame? And finally, the third question I ask myself is, if there is a potential recession, can the company still continue growing? So these are very important questions in my opinion, and today what I'm going to be doing is answering these 3 questions and going over 3 companies that I believe will do very well over the long term. I'm talking at least 5-10 years or so. So guys, this video took a long time to research. The best way you can thank me is drop a huge like down below, leave a comment as well, and share this video with a friend who you think this would be useful for. It really does help promote the video, it helps with the algorithms, and really helps out the channel as a result as well, and I really do appreciate it. Now, as a thank you, what I'm going to be doing for this video is giving one lucky subscriber as a thank you down below a 30-day free trial to my VIP membership group where you can see my whole portfolio and all the trades that I've made. And if you want to be eligible for that, all you have to do is drop a like and leave a comment down below. The comment can really be about anything, but as long as you do those 2 things, you will be entered into the contest. And of course, this 30-day trial will be 100% commitment free. You will not need to pay a single dime if you choose to cancel after that. So getting right into it, the first stock that we have here is Carvana. I'm not really too sure if I've talked about this stock on the channel before, but it's a fairly new stock to the market in general, and they're doing some pretty interesting things in my opinion. If you're not really familiar, Carvana actually markets themselves as the new way to buy a car. Essentially what their goal is to simplify the car buying experience for used cars, and they outline this on their website. So first what you do is you actually go create an account and browse all the available cars using their virtual images to get an idea of the car and what condition the car is in. And of course you can see more specs about the car as well and see any reports from previous owners as well. Now next what you'll do is set up a payment, which is scary, I am aware of that, because you will be spending a lot of money, and it's kind of a new concept here, paying for a car that's online before you even see it in person. But if you just hold on for a second, just give me a few more minutes, I'll go over why they have a really cool way of combating this and actually giving you some pretty good peace of mind as well. So anyways, you have a choice to buy with cash, use your financial institution, or get financing directly from them. And absolutely everything is done online, including signing the papers to your potential new car. So the next step here is getting you into your newly purchased car. So Carvana actually can deliver it for you, but if you want to pick it up yourself, you can. They have these Carvana vending machine services, and all over the country you can find one of these that's closest to you. But what if you don't live near one of these and you have to kind of fly in to actually go pick up the car? Well, you can book a one-way ticket flight to one of these vending machines which is closest to you, and Carvana will actually subsidize $200 off of your airfare and also arrange transportation for you to the vending machine. So it's a pretty good deal that they have going on there for their new customers. And really the final step here in the process is when they offer you that peace of mind guarantee. You know, because you just spent thousands of dollars on a car you never saw before. So say you buy the car and you change your mind on the car, well, every car that they sell is Carvana certified with a 100-day, 4,189 mile worry-free guarantee and a 7-day money-back guarantee. Now I'm sure you're skeptical about the 7-day money-back guarantees. What I did was I took a look into this more on their website, and in my opinion it's a pretty fair guarantee, and the conditions to meet this are pretty fair as well. So they say here that you can drive the vehicle up to 400 miles during your 7-day test own period. You can still return the car if it's driven over 400 miles, but every additional mile over 400, they charge you an extra $1 per mile. Now I think that 400 miles personally is more than enough to figure out if you actually like a car or not. Think about how much time you actually get at a regular dealership to test drive a car. It's much less than 400 miles. They also here offer exchanges, and all of this applies to as long as a car isn't damaged or modified, which again, in my opinion, is a very fair stipulation to have. So clearly Carvana wants to change how you purchase your next used car. And in my opinion, with companies like Tesla shifting to more of a showroom model as opposed to a typical dealership model, companies like Carvana will actually benefit greatly from this, and they can actually potentially partner with companies like Tesla in the future. So when Tesla gets used cars, they just send it to a Carvana facility, and then Carvana can take care of the rest. I honestly think that buying cars online is the future. I mean, every single thing is moving towards a more effortless, online, digital kind of purchase, and I think cars is the next logical step in that. Alright, so now let's move on and answer our 3 questions that we posed earlier. So can I see their market cap at least doubling? Well, they currently sit at under a $6 billion market cap, and their revenue is actually increasing at a pretty exponential rate. Last year, in fact, it grew at over a 100% clip. And if we take a look at the graph here, we can see what I mean by this. The rate of growth is exponential, and they are still relatively small when you look at the market they're going after. They currently pull in less than $1 billion in revenue, but I do think that this year they will surpass that and they will continue their growth. And if this growth rate continues, assuming we grow at a linear 2 times per year, some years maybe 3 times, some years maybe 1.5 times, but let's assume it's a 2 times growth rate as an average, then you can see that their revenue projections from 2018 to 2022, which is about 5 years, will be roughly $27.5 billion. Astronomical numbers, but very realistic in my opinion. And if we assume a 1-to-1 ratio here, usually it's going to be much more than that. For the market cap to revenue, we can see that it has potential to multiply by 4 times over that time period. So yes, over the long term, I can see their market cap at least doubling. The second question is, can I see their products become more valuable or needed out there in the world? So like I mentioned before, I think that the future of buying cars is really online, with the option to return it if you change your mind. Amazon is actually a perfect example of a company that spoiled us with absolutely effortless returns. And I think the whole world has to really adjust to this now with every segment of product out there, including cars. I think this is something absolutely needed in the market. And because of this guarantee that Carvana has, I think they're going to attract a lot of customers as they keep growing in size. So the answer to this question is yes, I do believe that their product is going to be needed more as we move on in the future. The third question we need to answer is, can Carvana survive a potential recession and continue growing? So this may be a slight issue for them, but I think the short answer here is yes. So of course, during a recession, people cut back their spending, and usually at the top of the list is new cars. But what Carvana sells is used cars. And typically when people are in hard times, they need a car, they're not going to be buying a brand new car, they're going to be looking at the best deal they can find on a used car. And that's when a service like Carvana can actually come in and help them, because they can browse through all these different options, maybe even purchase a car. If they change their mind, return it, maybe purchase another car. And because of this, there's going to be a lot less stress involved with the whole car buying experience when you're tight on money. So really, if we do hit a recession, I think that their growth rate might start decreasing, but their revenue still has potential to keep increasing, maybe not as fast, but still increasing nonetheless over that time period. All right, now let's move on to our second pick here, which is Shopify. It's a company that we've talked about on the channel before, but we haven't really talked about in a very long time. And I want to share my thoughts here on Shopify and why I think this may be a good stock to hold over the long term. If this is a brand new company to you, really in a nutshell, Shopify allows merchants to create an online store where they can sell their product to potential customers. And they can do this by leveraging Shopify's platform and really making the whole process very simple and easy to use. And similar to Carvana, Shopify actually has a 3-step process that they outline, which kind of gives you an idea of how this all works. So you can see here, the first step that they say is you build your brand. And here's where Shopify helps you with picking a catchy name and even with building a logo for free. Next, you actually go and build your online presence with things like a custom web address, some high resolution pictures, and other things to make your brand and website pop. Now, the third and final step is where the real money is at for Shopify. And this is when you actually build out the store using their platform by picking products to sell. And Shopify even offers themes that you can use for your store depending on what kind of product you're selling. Now, what's also unique about Shopify here is that they're a Canadian-based company, so that does give you a bit of international exposure as well. So the mindset here is that if the US does struggle, Canada might not struggle as bad or at all. Most likely Canada also will struggle, but it may not be as bad as the US. And as a result, you're kind of hedging your bets here by picking a Canadian company. So now let's look at our 3 questions here for Shopify. Number 1, can I see their market cap at least doubling? So similar to Carvana, Shopify has had absolutely incredible growth, massive growth over the last few years. Their revenue is also growing fairly exponentially, not as quickly as Carvana, but still quicker than many companies out there. And they also did recently pass the $1 billion revenue mark. So that's a huge accomplishment really for any company. So on average, they actually grow their revenue around 2 times year over year. But just to be safe when we're doing our projections here, let's just assume they grow it at 1.5 times. So looking at about 5 years out using these numbers, we can see here that Shopify will be sitting at around $8 billion in revenue. And although this isn't as fast as what Carvana grew by, I still think that it's extremely healthy growth here for a company of this size. Now, the only concern that I have about Shopify here is that it may be overvalued because it's currently sitting at around a $20 billion market cap, which is 20 times its revenue. However, they are still growing pretty fast, and with a growth rate of 1.5 times year over year, this potentially could be justified over the long term. But the real question is, can I really see Shopify doubling their market cap in the next 5 years? So in my opinion, it actually might take Shopify a bit longer to double their market cap. So 5 years might not be realistic, but I do think that in the next 10 years or so, they have a very high possibility of being over a $100 billion company. And this is especially true because as more and more people transition to online sales, a lot of websites that isn't your typical Amazon and Walmart and such is run by a Shopify-backed store. And as more people around the world get more comfortable with purchasing things online, this opportunity is really Shopify's for the taking. I would say at current prices, Shopify may be a bit overvalued here. I'd be more comfortable entering the stock at around $150 per share. So I'd be waiting on the sidelines to see if this does present an opportunity over the next few weeks or months. But on the flip side, if it's going to be a long-term hold, what I would do is most likely enter a position, and if we did dip lower, just lower my cost basis and just keep adding if we keep going lower, because over the long run, remember, I do think Shopify has potential to at least double their market cap. The second question is, do I see Shopify's product becoming more of a necessity in the future? And I think the answer to this is absolutely, and this is pretty clear and evident with the recent trend and shift to social media influencers selling their own products online. Now, a lot of YouTubers, especially out there, Instagram creators, Twitch streamers, you name it, they have their own merchandise that they sell online, and they typically use Shopify as a back-end store for that. And I'm under the belief here that I don't think this new way of shopping online is going to go anywhere anytime soon, especially as the new generation of kids grow up watching these YouTube stars. They want to purchase their products. They're not as interested in celebrities and other brands. They want to purchase products from their favorite creators like the Paul brothers or PewDiePie. And as this wave continues, and I think it's going to get much stronger in the future, companies like Shopify are going to benefit greatly from that. Now, the third question, which is also a very important question, is can they survive a potential recession and continue growing from it? Short answer, yes, I believe they can. A recession will no doubt hurt every company out there, especially companies that deal a lot of their revenue in the US, like Shopify. However, because they're Canadian, they do have that slight leverage where if the US does enter a recession, Shopify may not be as affected as other pure US-based companies. So you do have that going for you, like I mentioned before. You have some diversity there, and that may be a good reason in itself to hold the stock. But what I really like about Shopify is that they have potential to reach every single market in the world. So just because the US has a recession, it does not mean that other countries, say in Europe or Asia, are also going to be experiencing a recession. So the buying might actually increase in those countries if the US does decrease. So all in all, I think that Shopify actually answers all three of these questions as a yes. Now, the third company we need to talk about is a Chinese company, which we haven't discussed on the channel in quite a while, and that is JD.com. So in 2017, this was really the stock out there to buy, but in 2017, the stock really got put straight and its valuation got cut by more than half. But at its current price, it's a very attractive valuation here. And I know a lot of other investors out there have also either opened up a position in JD or are very close to opening up a position in JD because they do see the potential here that this company holds. So JD, if you're not familiar, they're actually a massive e-commerce giant based out of China. And really, they may very well hold the title of the most advanced logistics company in the entire world. They have over 300 million customers, 500 warehouses, and their revenue in 2017 was $55.7 billion US, which is much higher than the current market cap. And when comparing JD to its closest rival in China, which is Alibaba, JD is honestly just severely undervalued in my opinion, and quite honestly is just out of favor currently. The company did have a pretty horrible 2018 from a sentiment standpoint, but the numbers for JD really do speak for themselves with an incredible growth rate behind it. So the first question we gotta ask ourselves, just like with the other stocks, can I see JD's market cap at least doubling in the next 5 years? Well, looking at their growth year over year, you'll see this company is just full steam ahead. And fun fact, they actually pull in more revenue than Alibaba does. But anyways, if you look at the chart, you'll see that they actually grew their revenue about 1.4 to 1.5 times year over year, which is pretty impressive. And if they continue down this path of, say, 1.4 times growth year over the next 5 years, we can easily see their revenue close to around 2,000 Chinese yuan, which is about $300 billion US. Now, I'm sure the growth will eventually slow down, and that 1.4 times is pretty optimistic, but I don't think that it's far-fetched to see at least $200 billion in revenue in the next 5 to 10 years from JD. And currently JD sits around a $38 billion market cap, even though, like we discussed, it brings well over $55 billion in revenue in every year. Investors are worried that all the investments that JD has made in things like drone delivery and other logistics in their facilities may not actually pan out and pay off over the long term. But based on their growth and looking at a long-term perspective here for JD, I think that this will pay off and it'll actually become a very successful and highly profitable company in the future. So looking out 5 years and say where they pull in around $300 billion in revenue at that time, I think it's pretty safe to say that JD can easily double or even triple its market cap from its current $38 billion. As a comparison, Alibaba currently has around a $475 billion market cap, and Amazon currently has around an $800 billion market cap. But it's arguable that JD actually has the best logistics out there, even when compared to both of these two companies. So investors may really be underestimating the power of JD over the long term. And really, with these numbers, 475 billion and 800 billion market caps, it's not unrealistic to see JD at least at a $100 billion market cap as well. The second question, can I see their products become more valuable or needed? I think that this is a definite yes. JD actually caters to their Chinese customers, and Chinese customers really rely on the company to get high quality products that they want. Now, Alibaba usually targets the lower end with cheaper quality products and cheaper price products as well, but JD goes after quality here, so they do get a lot more revenue, and that's why their revenue numbers are much stronger than their competitors like Alibaba. And of course, third question, can they survive a potential recession and still continue growing? So being a Chinese company, again, I think that they're relatively safe from a US recession. But if the Chinese economy does enter a recession, JD could see their sales growth actually slow quite considerably, considering that they're primarily a Chinese catering company. However, their balance sheet does show that they do have more in cash and investments set aside when comparing to their debt load. So I think that they would be able to weather out a storm if the Chinese economy does enter a recession. And as more and more Chinese consumers are able to go purchase things online and the middle class keeps growing in China, they're going to want to buy a few nice things here and there. And of course, where are they going to go to buy that? JD.com. So yes, I think that they can definitely survive a recession and continue growing through a recession. And I definitely think that this company can become a much larger company in the next 5 to 10 years. Now you'll notice that all three of these stocks that I covered were all driven by consumer spending. But quite honestly, that's where the money is these days. This is how you have companies like Wayfair and other online services that primarily do business online grow at such an incredible rate and have their stocks grow at such incredible rates. It's because people realize that online purchases and online spending is the future. Out of the 3 stocks we talked about, I think JD is currently at a best value, Carvana comes in at a second place, and I think Shopify, although is a solid company, may be a bit overvalued at this point. And like I said, I would be comfortable entering the stock more at a $150 per share valuation. And really gotta remember that you can't really time the market, but if you're in it for the long term, it shouldn't matter whether you get into the stock at say $25 or $27, because you expect it to be much more, say $50, $60, $100 in the next 5 to 10 years. So guys, if you did enjoy the video, remember drop a huge like and leave a comment down below. In fact, if you stuck around to the end, comment ice cream cake, and that'll give you a second ballot put into a draw for the free 30-day trial for our VIP membership group. I think it's going to be an interesting experiment to see how many of you guys actually stuck around through this long video. I know it's a long video, but I really do hope you found some value in this. Guys, thank you so much for watching. Thank you so much for supporting the channel. I really do hope you find value in these videos, but either way guys, don't forget to invest positively. Peace.